Thank you, Malika. And on behalf of Edelweiss, I would like to welcome you all to the Q4 FY21 and FY21 conference call for Burger King India. From the management today, we have Mr. Rajiv Varman, CEO and whole-time director, Mr. Sumit Zaveri, Chief Financial Officer, Mr. Kapil Grover, Chief Marketing Officer, and Mr. Prashant Desai, Head of Strategy and Investor Relations. I would now like to hand over the call to Mr. Prashant Desai for his opening remarks. Over to you, Prashant.
Thank you, Nehal. Good evening, ladies and gentlemen, and thanks for being with us on this Thursday evening for the conference call. We truly appreciate it. Also, on behalf of everybody at Burger King, we hope and sincerely hope and wish that all your friends and families are safe in these tough times. And once again, thank you for joining. This is how we intend to take today's conference call forward. I will pass on the dais to Raj to make his opening remarks, post which very quickly I will take you through some of the slides on the presentation which all of you would have got a chance to kind of go through. We will then turn it on to Sumit Zaveri, my colleague, who will take you through the financial numbers quickly, and then I will hand it over to Kapil Grover, who will take you through the efforts that we did on the marketing side, plus our efforts on the cafes side, followed by I'll give you guys guidance and how we have revised the guidance, and then we'll open it for Q&A. The duration of the call is 60 minutes. Amongst the four of us, we'll try and wrap this up by about 20-25 minutes. So we leave at least 30-35 minutes for you guys to ask us the questions. If the time is not enough, feel free to write to me, email to me, or reach out to me, and I will try and answer all your questions to the best of my abilities. Thank you once again. I'll hand it over to Raj to make the opening comments. Raj, over to you.
Thank you very much, Prashant, and I second his comment. I hope everyone's keeping safe. The three mantras that we are advocating and everyone's advocating is wear your mask, sanitize your hands, and social distance, and vaccinate yourself if you can. And I know this vaccination availability is a tough thing, but when you can and if you can, please vaccinate yourselves. We are vaccinated, and you know that Burger King has a much younger employee base. So we just started after the under 45 started, but we have vaccinated about 15% of our employees, and we continue to kind of move forward on that in a rapid basis. So please take care of yourself and be safe. What I'm going to do is I'm going to take a few minutes because you got some very intelligent people to follow me. I'll take just a few minutes to just give you a roadmap, and once you have the roadmap, then we'll go into the presentation deck for Q4. So first of all, just as I remind myself and my team, we are a very young company. If you look at our company, 50% of our restaurants in our company are actually less than 2 years old, 21 months to be exact, and those 21 months actually include 14 months of COVID in there as well, right? And if you take the entire company, all the 258 restaurants, company-owned restaurants, there's some franchise restaurants as well. If you take those, then you'll find that those total average to about 36 months of life, right, of age. So a very young company. So there's a lot of growth that will happen within those four walls of each restaurant beyond the growth that we are putting in building new restaurants. So there's going to be growth within those four walls and then growth beyond those four walls. So let me first talk about the four-wall growth, which we have been, speaking to you guys in the past, and we'll continue to speak to you in the future. Now, if you just reflect back on FY18, we were up about 12.2% that year, and that year's growth came through the launch of our Value 1.0. We call it 1.0. So we launched that value program, and the growth that came in that year was because of the 12.2% growth that came was because of the value program. In FY19, we had a 29.2% growth, and this was growth both in SSSG as well as SSTG. And this growth of 29.2 was roughly half that came in because of our value program that we had instilled the previous year that we now put on television, and we grew that business within the four walls of the restaurant. And then half of it came because we launched the delivery with our aggregators. So our delivery program launched with the aggregators. Remember that our entire delivery was only through our aggregators. still was until this last quarter or so. So we were at that point only delivering through aggregators. So that 29.2 that you saw in that year, roughly half was through aggregator growth, through delivery growth, and half of it was because of our value program. Then in FY20, we had a kind of a flattish year, and that flattish year was reconsolidating just the sales of 42% that we had increased, 42% SSG over the last 2 years that we had, in addition to putting over 70 new restaurants into the ground, right? So that was that year. Now, we are poised as we move forward to bring in two things. One is, and Kapil will speak about this in depth, so I'm just going to give you top line on this. The first thing is we are getting the Value 2.0. So we are launching now the Value 2.0, and you will see very soon across the country in your television sets and in every other place that we usually communicate our programs. So that Value 2.0 is going to be launched. In addition, we spoke last time when I first spoke with you for the very first time. We spoke about our app and the fact that this app was in progress and that we were building it up and it was almost going to complete. Well, the good news is that app is today available on your phones. You can download it in Android or you can download it on your Apple phone. And we've got close to 1 million, I think, by the end of, by early June, we should have about 1 million downloads. So we just kind of started it and it's kind of gaining ground. So we are going to, in addition to this pillar that we had, aggregators pillar, where we have, multiple aggregators that do that delivery business. Now we are building a pillar of our own app business, and that's going to be a new pillar to build the four-wall sales SSG that I was talking about. So that's a big one. And then the second one is the Value 2.0. So this is a little bit, and we'll have a detail from Kapil on both these items as we go into the presentation. And then the outside of the four walls, we will continue to build restaurants. We haven't changed our guidance for this year. We continue to, shoot for hitting, 320 restaurants by March of next year, which is March 31st of next year. And this is because, we have already opened 3 restaurants. We've got 8 in construction. We've got a pipeline of 30. So we feel good about it. The only reason that it's not our ability to build those restaurants, it's only going to be whether we want to do it. Because I think we will make those judgments as the COVID-19, lockdowns reopen. So we will make those judgments. But the ability, the pipeline, the talent, the staffing resource is all in place to go ahead and continue to build a 320 and continue our journey towards the 700 restaurants that we spoke about in the last call. And the last piece that I want to touch here is a brief announcement that you saw yesterday when we put our deck on in the evening on the portal for you to review. We are launching BK Cafe this year. We will be launching it towards the end of the year. This will be, something that we will be working on. We have done a lot of work. Kapil will speak to that in a minute. But we have, done a lot of work on the design. We have done a lot of work on the menu. We've done a lot of work on equipment, and we are just going to be finalizing those things and bringing them to fruition towards the end of this year. And then the following year, we will be building 75 BK cafes as well. So there's a massive program for us to bring BK Cafe up front and move that forward. So with that, Prashant, I think we dive into the deck. Sorry, I kind of ran a little longer than I should, but I'll turn it over to you back again so you can guide through the rest of this meeting. Thank you.
Thank you. I'll quickly take you through some of the slides and what we are trying to communicate there, and I'll be quick about it. So if you come to slide 3, for those who have the presentation in front of you, essentially what we are saying is our revenue recovery in Q4 was 103% YOY, and our ADS recovery in Q4 was 92%. And we have shared some data with you to kind of give you guys a sense in terms of what was the recovery on the delivery side and on the dine-in side. We also shared data with you in terms of what our recovery was regional-wise. So West was at 116%, South and East was at 113%. And our sense is we did better than industry, and North was at about 108%. One important point we want to kind of drive home is that Q4, our gross margins were 65.6. And 2 points I want to highlight. One, what Raj mentioned, that it's still early days for us in the country. We're just about 6 years old. And second point, if you guys would recall, last time we had kind of guided that we'll end FY22 at 65.5. We have already achieved what we probably intended to do next year in the last quarter itself. Driven by gross margin improvement and operating cost efficiencies, we reported a restaurant level EBITDA of about 14 crores. Next slide, 14. The only thing that we would want to kind of highlight, which Raj mentioned, we are on track to take the total number of restaurants to 320 from about 265 where we ended 31st March with, and the currently restaurants under construction stroke pipeline at 38. So we feel reasonably confident and comfortable with that number that we are guiding today. Kapil will discuss a lot on the app side, but just to give you on a very small base yet, but the BK app delivery revenue growth was 2x on a quarter-on-quarter basis, and we are seeing massive traction on that. Kapil will also obviously get you guys up to speed with our strategy and its impact on our gross margin on the stunner menu that we have launched, where we are trying to redefine the way India looks at value in the international QSR space. And of course, the big news of us launching BK Cafe in FY22. Currently, based on everything that we are going through, we should be able to, beginning of next financial year, January on, we should be able to launch BK Cafe, and Kapil will delve a little more on the concept over there. Next slide is again just giving you a store ramp up, not just where we plan to be in FY22, but our guidance in FY23-24. And as some of you are probably joining for the first time on this call, our requirement under our MFDA that we've signed with BK Corporation globally is to reach a number of 700 Burger Kings by December of 26. Next slide will give you some sense in terms of when we reach that number by calendar year 26, December 26, 700, how will geographically we be spread? And again, as Raj keeps saying, this is just a milestone in our journey. This is just one full stop or a comma. Post December 26, you will see us adding a lot more restaurants. Clearly, the yellow in the map shows Northeast is somewhere we'll start building out after that. West also, if you see, by December 26, will only be 165 restaurants, where our incumbent is more than 300, even more than that number even now. So there is a lot of room for us to grow even beyond CY26. Quickly coming to a broader business update on slide number 8, we have shared with you our recovery right through April of 2020. The only thing that I want to kind of highlight is the March 21 number, and something which is written in fine print, that the second wave, the further dining restrictions started somewhere around March, and yet we are at about 111% ADS recovery. Next slide, we have shared with you, quarter-on-quarter regional breakup of our recoveries. Again, it's pure data. If you have any questions, happy to take them post this call. Next slide 10, we shared with you what our dine-in and delivery mix was ending March. As you probably will see from that, dine-in was 57, delivery was 43. Interestingly, the recovery on the delivery side has been absolutely robust. The recovery is now 124% in March, and dine-in recovery, you guys will probably know from our last call, 55% of our stores are in malls, which took time to kind of open up. Within then multiplexes, we were expecting big blockbuster releases sometime around April, but because of the lockdown, we did not have that. So the dine-in recovery lagged delivery recovery, but it was still at 93% in March. Next slide, slide 11, is on a SSSG, trying to help you reconcile with what we went through. Raj has spoken extensively on this in his opening remark, that we were coming on a very large base, and obviously COVID. So that's the data point on same store growth. Coming to financial performance, I will now hand it over to Sumit, our CFO, to quickly take you through those slides. Sumit.
Thank you, Prashant. What I'll do is that I'll kind of quickly talk about the key highlights as far as the financial performance is concerned, and then request Kapil to take on from there on to explain the marketing and the growth part associated with that. As far as the overall revenue is concerned, we did a revenue of 195 crores for quarter 4, up from 163 that we done previous quarter, a growth of 20%. One of the key highlights on the financial performance that I want to really kind of draw attention is on the gross profit side. We moved up from 63.9% to 65.6%, an improvement of 1.7% on gross margin. As Prashant initially was talking about, we kind of we had guided the market to 65.5%. We've already got to that in quarter 4. And in line with that, we would be revising our guidance for next financial year. And then as Kapil talks about some of the other initiatives, the guidance for FY24 also would then accordingly stand changed. And we will talk about it when we come to that. As far as other cost line item is concerned, just want to draw your attention that we've literally, with the help of our development team, we've been kind of talking to the landlords and got substantial relief in rentals. Quarter 4, we had a rental relief that we had taken to P&L around 16 crores, which in the current quarter is 4.5 crores, and that is effectively the main difference when we literally come down into the restaurant EBITDA level. We had a restaurant EBITDA of 14 crores and a company EBITDA of 0.2%, a margin of 0.2% or 46 lakhs. We report numbers on after considering the change in the lease accounting standard. Based on that, our company EBITDA stands at 12.5%. And going forward, we would effectively start reporting the numbers and our financial performance discussion on a post-Ind AS basis. So with that, effectively, I would kind of hand it over to Kapil to take us through the marketing update for the quarter.
Thanks, Sumit. Good evening, everyone. As you saw, the last quarter we had good sales recovery, and that was driven by a strong marketing calendar. Now, just before I talk about our calendar, our menu is kind of a barbell strategy, right? On one end of that barbell is our signature premium menu, which is the Whopper and our recently launched King's Collection, which helps us drive frequency and premiumization. On the other end is our value menu, which helps us drive traffic. Yeah. So let me first talk about the Whopper, and I'm on slide number 15. The Whopper is one of the most differentiated and unique products in the category because of its size, quality, and the taste experience it offers to the consumer. Now, we are investing behind building Whopper almost as a sub-brand of Burger King. And this quarter, we ran a trial program to get consumers to experience the Whopper. And we saw fantastic response where we saw 50% increase in volumes and a significant increase in awareness of the Whopper from 4% to 53%. Now, in addition to this trial offer, we also launched Twisted Whopper. Now, this Twisted Whopper is part of the Whopper limited time portfolio. So what does that mean? This menu of limited time promotions around the Whopper, these are different products which are designed to drive taste excitement and frequency with our current users. And that also got a great response from our fan base. We also integrated Whopper in our topical activation like Women's Day to drive saliency and revenue. So that's about the Whopper. On the other side of the barbell, on slide number 16, is our value menu. As Raj mentioned, this is our Value 2.0. Now, we've soft launched a branded value proposition, right? It's called the Stunner menu. Now, unlike other price point-led value menus, this menu offers a stunning variety of products, a variety of formats like burgers, wraps, rice, innovative formats like Volcano, and delivers a great taste experience to our consumers. And also, all our veg items here are priced at one price point of 50, and all our chicken items are priced at one price point of 70, right? And while we'll offer great value for money to the consumers through this menu, which will be scaling up in due course, we are making sure that this menu remains margin accretive. Now, some of you might notice on this chart, there's a line on the menu which says no synthetic colors and artificial flavors. Now, that brings me to the next slide, number 17. We all know that consumers today, and especially Gen Z, is very, very demanding of brands to be very, very authentic, and they're very conscious about the provenance and the quality. right? So we have taken this bold step to keep our brand relevant to our audience and removed all synthetic colors and artificial flavors from Burger King products. A lot of R&D went behind this, a lot of work behind this to develop this menu. And on 29th of March, the app day to talk about colors going away from food and going into a festival of Holi, we launched this activation, and we stay committed to offering nothing but the best quality of ingredients to our customers. Now I will move to slide number 18. As you're aware and must have noticed that Burger King as a brand is globally known for connecting with its consumer in a very authentic and a light-hearted manner. And it's the same case in India, right? In the Indian youth also seeks and inspires authenticity, right? So we echoed the popular sentiment amongst, the youth of India against sensational journalism with our activation around Whopper against sensationalism. Then on Valentine's Day, we collaborated with the matchmaking sensation Seema Dapadia, right, and her point of view on no compromise relationships. And finally, Whopper Fridays, which is our weekly influencer program where we connect with the influencer community, the bloggers community, and drive a lot of engagement with our target audience. All of these initiatives drove over 300 million impressions for the brand on social and digital channels. So that brings me to slide number 19 for those who are following the presentation. And from here, I will talk about two very key strategic initiatives as Raj and Prashant also earlier outlined. Number one, we are building the Burger King online ordering platforms. Right now, we all know the trend on delivery. Right? Even before the pandemic, delivery was growing, and consumers were adopting this channel for convenience. Right, and the trend got accelerated in the last year, even more so. So while we continue to build our delivery sales with our partners and aggregators, we believe that BK app is a channel will be largely incremental in the future. And last quarter, I had shared with you that we started work on the app, and this quarter we're seeing some early results. As Prashant mentioned, we're already seeing some early traction with about 200% growth in our app sales. We've invested in technology, resourcing to make the app faster. The app is now faster by about 40%. We've improved our delivery times, again by investing in technology at the back end on delivery logistics and rider tracking, right, which has improved our delivery times and our service levels. And we're seeing significant increase in our monthly active users. And that's something that we'll stay invested behind. That brings me to the second strategic initiative, which you've heard in our presentation yesterday, is the BK Cafe. Now, as millennials and Gen Z increasingly adopt coffee as a lifestyle beverage, we believe this is an opportunity to drive incremental occasions, leading to top-line growth and good margins for Burger King. Now, we will be offering consumers a modern and contemporary cafe experience, and we intend to scale this up to about 75 stores by the exit of FY23, and you will certainly hear more from us in the coming quarters around this. By the end of this year, we will be launching a few stores. From here, I would hand over to Prashant to share the outlook.
Thanks, Kapil. So guys, yes, extremely excited about the things that are lined up for, internally for our business and also to deliver to you guys as well. In coming to guidance, and we had consistently shared our philosophy of guidance that will probably guide you guys on three numbers. One, on our store expansion strategy. Second, on our SSSG. And third, where we see the gross margins going. There is no change in guidance when it comes to number of stores. We remain committed to 320 for FY22 and 470 for FY24. No change in guidance as far as SSSG is concerned. We believe the SSSG over FY20 this year, once things normalize, will be kind of flat. And next year, we are currently budgeting a 5 to 7% SSSG on a normalized numbers. We are upping our guidance when it comes to the gross margins. From 65.5, we are increasing our guidance on gross margin by 50 basis points for FY22, and further by from 66 to 68 by FY24. As you all know, by FY24, cafes will also come into the picture. Currently, in this guidance of 68, we are not factoring too much coming from cafe because we have to first, launch and see how that business does. So guys, that's from our side in terms of what we had to share with you, and we have another half an hour to kind of take questions. So request the moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avi Mehta from Macquarie. Please go ahead. Mr. Avi Mehta, your line is unmuted. Please go ahead with your question.
Hi, am I audible now?
Yes, Avi.
Go ahead.
Oh, I'm really sorry for that. Thanks for the opportunity. My question was on the gross margin. I mean, this gross margin performance, does it suggest that BK is considered a more premium brand by the customer and not necessarily a very, economy or value kind of brand? And if it is the case, would the focus then rationally be more on launching in the barbell strategy more on the premium end?
Thanks, Avi. I let Raj take that. Raj?
Yeah, thanks, Prashant. Ravi, actually, the GP or gross margins is not a direct result of one number. That's usually the perception of most people that, it is basically the price of the item that you sell. And I've been, sharing this for now 3-4 years here in India. It is a result of several things. The first thing I will tell you is what Kapil was talking about earlier on. It's called the barbell strategy, where you have a strategy to drive traffic in. So we have value-driven traffic driving initiatives in place. We had value 1.0. We are now moving to value 2.0, and that continues to drive traffic in. On the other side of the barbell is what he was talking about when he said that we have this Whopper brand, that we are building this brand, and we are taking this brand to the next level. So there's a menu mix or a product mix strategy that is effective in bringing the gross margins to where they are. That's just one of them. Obviously, there are other factors that go in there, like, the way we grow. We grow very, very, as we call it, the cluster growing mechanism, wherein we are not putting restaurants randomly across the country. We are strategically building those restaurants so our transportation cost is minimized and it's most efficiently done. So that's another strategy we do. We also then build a cluster to make sure that distribution cost is amortized over those restaurants. So that's another piece of the strategy that we do to bring gross margin. And also we have a very strong buying, culture and a very strong buying strategy in which we have multiple buyers, people selling, multiple suppliers for particular products, and we use that very effectively in bringing down the cost at the door itself before the product comes in. So all these things come together, and that's why you see that at a very young age of this company that we continue to drive some very good GPMs. I hope that answers your question, Ravi.
One thing, Avi, I will add to this, to what Raj is saying for the purpose of people who are joining our call for the first time, is, our cost of goods sold, Avi, also includes the distribution cost. So when you look at our gross margin, what Raj was also mentioning, the cluster approach where we kind of take efficiencies on the distribution side also helps us drive home the point.
No, so just let me if I can follow up. The 200 bits expansion that we have kind of done on the FY24, that is, if you were to split it between the efficiencies and the premium, what would the rough split be? I'm not looking for exact number, but would it be fair to say that it will be largely driven by efficiency gains, or would it be fair to say it is largely driven by premiumization?
So let's put it other way around, Avi, to answer your question. A large part of that is going to be through efficiency. Product mix change is something that's difficult for us to sit over here and forecast and predict. But as Kapil said, because we are consistently going to build Whopper as a property, which is a premium product, there will be some element of product mix change, but large part of what we are guiding is based on efficiency.
Okay, perfect. So that clears from that. And the second bit essentially is on any consumer trends in behavior that you've witnessed in March. That was the only normal month, if I may say, that we witnessed. So anything that you can kind of give us a sense, and any sense about 1Q, if you can share. That's all from my side. Thank you very much.
Take that.
Well, hi, Avi. I think, March was, early parts of March and Feb was the only time that the lockdown opened up a little bit, and we saw some traction come back in the dine-in channel and the takeaway channel. But yeah, this is a very unpredictable pattern right now, right? We've again seen a wave of lockdowns come in. So it's right now unpredictable. What we've certainly seen is that delivery has become a bigger channel what it used to be pre-lockdown. It's become a channel driven by convenience and safety. And as the lockdowns open up, this consumer behavior will sort of settle down into a new normal, which is the oft-used phrase. And there will be some gains on delivery, but dine-in and takeaway will come back in its own form once the lockdowns come out. But as I said, it's unpredictable right now to sort of put a number on it.
Thanks, Avi.
Thanks a lot. Thank you, sir.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. My question pertains to our SSG guidance. So considering that 50% of our store is very young, and then all the initiatives that we spoke about, is our guidance very conservative on 5 to 7% SSG growth?
Yeah, whichever way you want to look at it, Tejas, it's difficult for us to currently, given the environment where we are. Currently we feel comfortable guiding at a 5 to 7%, and our thinking there is that there is generally a 3-4% price increase which most international QSRs take in a year intelligently, and then the rest is kind of going to be driven by the traffic growth, which will again be a function of how the GDP performs. So we feel confident and comfortable at a 5 to 7%. And as I mentioned in the previous call here, this is a moving number, moving target. If the business dynamics change in a quarter, which might kind of, will give us the confidence to kind of come and up the guidance, probably next quarter after that, we'll come and revisit that. But currently from where we are sitting, this is the guidance we are comfortable guiding you guys at.
Sure. But this will be largely driven by price hikes or food inflation, or in general, you believe that if your throughput also will drive SSG going forward? Because the stores are very young. That's why my question is on it being a very conservative number.
Fair point here, but currently you can take it as a 50-50 split between traffic growth and price increase.
Sure. Second question pertains to our store expansion guidance, and you have been very categorical on what we want to achieve by 2026. So in terms of capability, how should we think? Will it be steady state, same run rate kind of addition every year, or we have capabilities to step up, accelerate the pace if the environment allows us? And what is the maximum number of stores, if I may rephrase the question, what is the maximum number of stores if macro allows us to, or supports, we can open in a year's time?
Let me take that.
20 stages we opened 73, so that's something that we have demonstrated from an execution standpoint. But I will let Raj kind of give you a much more holistic overview on your question. Raj?
Yeah, thank you, Prashant. So Mr. Shah, if you look at our study that we did back in 2013 when we first started putting this whole plan together. On a spec max, we had put in 1,000 locations at that time. So you're talking about 7 years ago. That was the kind of potential we saw when we kind of drafted this. This is the reason we signed on to a 700 MFTA plan, knowing fully well that the potential even 7 years ago was about 1,000, right? So that was very clear to us in that respect when we started this whole game plan. Now, as we continue in that slide, that if you can go back to that slide and see where Prashant was talking about, the appearance of our restaurants, in 2026, how it's going to look. And you see that it is very uniformly distributed with a lot of gaps as well in the whole chart, which tells you very clearly that the potential, even if you look at the west and south, the competition has more restaurants today than what we are planning in December 2026. So the potential even in that market at the end of December 2026 will be much more than what we are going to build. Now, as far as the pace of growth, you just have to look at what we have done in the past to project what we are going to do in the future. Every year, we have outperformed the MFTA except this COVID year, right? The COVID year was intentionally, we put a kind of halt as a company. But if you look before the COVID years, every single year we have outperformed the MFTA. There's no reason for us not to do that in the future years if it makes sense for us to do it. If we are not following, just the MFTA, but we're following the business opportunity. And if the business opportunity, prevails and we have a pipeline, we will absolutely execute it much faster.
Thanks, Raj. Thanks, Tejas.
Yeah, thanks. Yeah, just one follow-up, if I may squeeze in. This is an observation and perhaps academic in nature also question. But any reason why Eastern UP, even in 5 years, we are not getting or having any store there?
No, actually, Mr. Shah, we have started Eastern UP. We have got Varanasi. We have gone into Lucknow. We have gone into Kanpur. We have gone into a lot of cities over there. Allahabad, we have gone in there. So we have just started building it. Like I said, we have a very disciplined approach to how we build. We just don't just go erratically across. We build a hub, and we build a DC, a distribution center, and then we start building so that we keep our total cost to our company, to those restaurants, very effective. It would make no sense. I've got opportunities. I've got 2-3 sites in Guwahati, which will be, 3 lakhs, 4 lakhs kind of area sites. But I'm not jumping and going into Guwahati until I build a Kolkata base and then, go out from there and build out the outlying cities. So it's a very disciplined approach, and cluster mechanism is the way we grow, and we kind of trying to stay disciplined to that. But we have gone into Eastern, just to let you know.
Okay, so the dots in your slide 6. Yeah, yeah, sure.
Sir, I would
Thank
request you to rejoin the queue for follow-up questions.
Sure. Thanks.
The next question is from the line of Vicky Punjabi from JM Financial. Please go ahead.
Hi, sir. Thanks for taking my question. Just 2 questions from my side. One, I just wanted to understand if you have any guidance on this cafe as to, is there any, what are the experiences from the global side that, that kind of gives you confidence on expanding this at such a fast pace? And what's the kind of investments that would be required in this segment?
Yeah, this is, we obviously have our numbers, and we are kind of moving with a very decent homework. We will share these kind of informations in the future. We always want to put something in the ground, get the experience of it before we start sharing externally. So if you kindly wait a little while, and we will get back to you with those numbers, and we will get back to you with those projections. But right now, we just want to make sure we're doing our homework better. Yeah.
Vicky, we'll build the excitement quarter on quarter on the cafes. Just be a little patient with us. You will see first phase of some excitement next quarter, and then thereafter. Just give us a quarter's time to kind of come back to you on some of these things.
Sure, sir. Okay, sir, just, I had 2 more things. One was on the delivery versus dine-in. Now, if I look at the way dine-in, kept improving from, say, 29% in May 2020 to 62% as a proportion of the mix till Jan 21. And then suddenly saw a dip in March. Any reasons for that? While I think that both have grown, but just wanted to understand what happened, because I thought that 4Q was a very normalized quarter.
Yeah, that's a good question. I think Prashant was saying this, or I think a couple were saying it. The market has been very erratic. Even we have a complete setup to find out which city is now closing down dining, which city is now closing down takeaway, which has a curfew that starts in the evening at 6 o'clock. There is a lot of nuances which have moved dining to delivery and delivery to dining. So if you start doing the math on that, I would suspect that you would be here all night trying to do that. Look here, a lot of small things are happening, where the death rates are going up or the infection rates are going up. The government is clapping down literally in starting from next day or the day after, right? So the clapdowns are very sudden, and you will find that a lot of shift. I think Kapil was articulating earlier that look at this, as we see it, once the vaccination program is in place and people are getting vaccinated, and as things are opening up, it will take a little while for people to slowly come out and start experiencing brands again. But in due course, as we look at this long-term basis, we see that this is still going to be a substantially strong business in dining. It's going to continue as a strong business. I've articulated in the last call, and I'll share just two examples very quickly with you. If you look at malls, for example, people go and visit those restaurants in the mall. They go shop in the mall. They visit the restaurants in the mall. And that pattern of that habit of those customers is not going to change. Our restaurants on drive-thrus on freeways, we got about 25 drive-thru restaurants. We continue to build. That's a massive strategy of ours moving forward. Those are restaurants that will get a drive-thru visit. That people will go on the road. They're traveling from A to B. They will use those. So there's a certain habitual and basically a habit that will continue to drive that sales in there, right? And even in high street, if you come down there, that business will come back. Now, I think we might see a skew over the next year, 2 years. We are sitting at about 27, 28% going into the COVID years, into the COVID months. And we think that will be slightly north of 30, maybe 30 to 35. But again, I think I resonate with what Kapil was saying, that this in the long run will kind of land where it lands, where it was in the past, because there's a certain pattern of way people use it, whether it's in the malls, whether it's on drive-thrus. Those patterns will not change.
Sure, sir. So just one last.
Sir, Mr. Punjabi, I would request you to rejoin the queue for follow-up questions.
Sharika, Kapil is adding something.
Yeah, Vicky, just to add to your, what Raj mentioned to your question, I think specifically in March, there was just a 1% delta there. There was a delivery push because there was a cricketing event in that month. That also helped drive delivery sales a little higher. And towards the back half of March, there were a fresh wave of lockdowns in Mumbai, Maharashtra. Malls were shutting down. They were being asked to present RT-PCR reports for entry. So that has some impact on dining, and that's why you see that 1% delta between Feb and March.
Sure. Thank you, sir.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, sir. Good evening. I have two questions, so let me put them up front. Firstly, if I look at your SSSG this quarter at about -5 versus the other burger chain which has done a +10 kind of SSSG this quarter. So just wanted to understand why such a huge difference of 15 percentage points between you and the competition. That's one. Secondly, if you can give some idea on a sales per store basis, how are your older stores, let's say, whatever way you're looking at it, more than 2 years old or more than 3 years old, that cohort, what is the average sales per store of that cohort versus your overall company average sales per store? These are my two questions.
Sure. So Percy, I'll take the question on SSSG and I'll let Sumit kind of give you details on the store cohort. On the SSSG, as Raj kind of was trying to kind of explain or drive on that point particularly, that one, we are coming off a very high base. That's one. Two, for us, the delivery contribution to our SSSG began much earlier than industry, because we were the first ones to onboard delivery way back in 2017, 2018. So whereas the industry is catching up with the delivery incremental business, we've kind of caught on with that. Third piece, if you look at our portfolio, 60% of our stores are in North. And second point that I made earlier as well, 55% of our stores are in malls. Jan, Feb, March, early Jan and Feb, winter in Delhi, farmer protests, Punjab, not allowing stores to open on the weekend had an impact. And obviously the mall stores kind of did not perform as well as the high street. So if you kind of combine all of this, the answer somewhere lies, kind of therein over there, Percy. And, I let Sumit give you some kind of a direction or color on the cohort that you are asking.
Sure.
Thank you, Prashant. So as far as cohort-wise things, while I wouldn't get into individual cohort-wise growth, but the way our portfolio generally works is that once we kind of enter a particular store or a market, we've seen a very strong growth coming in year 1, year 2 of the opening of the store. And then continuously as we continue to penetrate deeper into the catchment area where we are present, we continue to see the normalized SSG growth to continue, which is what the growth that we are guiding to the market, that we've seen that continues to kind of be seen thereafter from year 3 onwards or so. And we've literally at this point in time not seen any of our stores seeing any form of maturity or peaking in terms of sales growth is concerned. So we still continue to see a continuous penetration-led, catchment penetration-led growth at all our stores.
So if you can't give a exact rupees number, would you able to at least give a percentage difference between the older cohort and your overall company average? That would also really help us. Where I'm coming from is that your margins are very low. And one of the main sources of margin growth will be your operating leverage, because in an existing store, if you make 1 rupee extra, 66 rupees of that more or less will flow to the bottom line, and that is what will give you your EBITDA margin. So if I know what is the difference between the older stores and your company average, that helps me to model out what kind of margins your company can make in the longer run once all the stores come up to that kind of a level, or a large percentage of the stores come up to that kind of a level. That's where I'm coming from.
Fair point. So Percy, let me answer it. I try and give you a sense. So, in the first call last time we mentioned that pre-COVID, our portfolio-wide average was about 1,10,000, 1,15,000 on an ADS basis. If you look at the stores that we opened in 2016, 2017, and which will be entering their 5th year, that would be about 40% higher.
Okay, that helps. Thanks a lot, Prashant.
And that also just, you got to understand that those stores also are young stores, right? They're also not stores that have been on the ground for 5, 6, 7 years. So there's going to be continuous growth within the 4 walls of those stores as well. So that, just take that in perspective as well. But you can at least, you can see the gradient. You can see the gradient between the two, I think, which is what you're looking for. That makes sense.
Right. But that also brings back to Tejas's point that if the older stores are 40% higher and your younger stores are such a big cohort, then the growth rate of 5 to 7%, I think, is on the conservative side.
It is a fair remark here. What do we mean? As I mentioned to Tejas, Percy, that's where we feel comfortable. One small clarification on that I will give you is when we are guiding 5 to 7% same store growth for FY 23 and onwards, in that we are not factoring the cafe growth. So that obviously will be loaded on that. But currently that's where we feel comfortable. And as I said, this is a moving target. We'll revise this every quarter should the business give us that confidence.
Thank you. The next question is from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Good evening. So 2 questions. Firstly, on the flexibility in terms of the kind of stores that you can open. Is there any scope of tweaking the size of stores down if delivery becomes a large part of the business, especially given we are now talking about 3rd, 4th wave of COVID? And if tomorrow you find, say, dark stores feasible, would you have independence to do the same as part of your overall guidance on stores?
The answer to that is yes, Prasad. The MFDA kind of gives us complete flexibility to pick and choose where we want to open the stores. As we mentioned in the previous call, because we were starting out somewhere in 2014, 2015, all the malls were low-hanging fruits, consumers' footfalls were high, so we kind of went and took leadership position there. As we mentioned last time as well, going forward, if I'm going to say open 50-55 stores in the current financial year, will incrementally 55% of my store comes out of malls? The answer to that is no, because there are only about 10-15 stores across the country coming up in malls. So from that perspective, going forward, the mix will change, and we have absolute flexibility, not just with respect to the mix, but even with respect to the size that we choose for each of these stores. Because, as Raj mentioned in one of his comments, this is one of the most important and critical capital allocation decision that kind of the company takes, driven by Raj, is on store opening. So we want to believe that we've been disciplined so far, and we will continue to kind of adhere to that kind of a discipline.
So just to clarify, even a dark store will be counted as a store in this setup.
Correct.
Okay. So the second question is, post-COVID, has there been any feedback or support mechanism for Burger King as a brand owner to overall help franchisees, like say sharing as to what is working in the different geographies or any such support?
Yeah. So let me take that, Prashant. Yeah, I mean, there's multiple kind of avenues of that support that we have got from our franchisor. If that's the question directly answering it, yes, it's not only just the insight and support, and then also both. They have been nothing but a fantastic partner all through the journey. So we are very blessed to have this kind of franchisor. Thank you.
Thank you. The next question is from the line of Amnish Agarwal from Prabhudas Lilladher. Please go ahead.
Yeah, hi. A couple of questions from my side. First, can you share with us the breakup of our stores, that how many are in malls, how many are in, you can say, your metros, transit locations, and food courts, etc.?
So Amnish, so of the 256 stores that we have, 55% of the stores are in mall and food courts, 30% are in high street, and the balance 15% are in drive-through and transit being just 5%.
Okay. And my second question is regarding the guidance. We have said your FY20 level of SSSG. Okay, so are we referring to your sales per day, because or we are in FY22 saying flat SSSG means basically the SSSG level of FY20, what exactly we are referring to? And the second part is that given the fact that we are going to launch cafe, which has got much superior margins, and we are already running at 65.5, 66 kind of a run rate, do you think 68% could be a conservative number in FY24?
I let Sumit answer on the first part. On the second, you guys all look at data, right? If you think 68% is conservative, no, I don't think it's conservative. I would want to go. It's a realistic number, Amnish, today from where we are sitting. And believe me, there is a lot of work that needs to go to kind of achieve 68. Because as I mentioned, I think to Avi as well, what you are looking optically 68 is closer to 70, because there is about 200 to 250 basis point of distribution cost, which for us comes within cost of goods sold. So if I'm kind of guiding that I will be at about 70% compared to industry, it's a realistic guidance, but we'll all have to work very hard to deliver that number. And that's how we are kind of putting pressure on us by coming and kind of putting this as a guidance so that it's motivating enough for all of us. So I would want you to read this more as a realistic number than as a conservative number. And yes, keeping fingers crossed that we surprise you. But I'll let Sumit answer on the SSSG side.
Yes, just before you go, I think Prashant, one of the things is obviously we have just kind of got into the cafe business, right? So we are not factoring all the efficiencies of the cafe business completely coming into this in the first year or so, right? Because you're going to start off small and then you're going to put it in there. So it's gradually going to seep into our business, and you'll see those benefits down the road. And you're absolutely right. But again, I say, your future. If you look at the past and your performance in the past, it's a good indicator of your future. We set a target of doing a 66.5 kind of a GP. We already hit that in the first quarter. So we went ahead, 65.5, 65.5 target for this year, and we already hit that on quarter one, and then we strengthened our guidance to 66. So I think we'll continue to be that kind of a company, if you will. We will always want to over-deliver and do a job that we think we can do. So over to you, Prashant. Sorry, to Sumit.
Sumit, yeah.
Yeah. So I'll just answer the first part of the question that you had asked, Piyush. So when we are talking about SSSG at levels of FY20, what we literally are moving towards is that when normalcy comes back, the portfolio level average daily sales per store, we effectively go back and achieve what we would have achieved in FY20. We are basically benchmarking ourselves to FY20 levels. Because of the period thereafter till now is COVID impacted. And if I was to earlier part what Prashant was talking about during the earlier question that was asked on where do we stand on our ADS, effectively portfolio average ADS we are talking about of 110 to 115,000 once effectively things start coming back to normalcy.
So guys, we have time for another 3 questions. So 3 people. So if we can, I would request the moderator quickly, get on with that. Thank you.
3 people, but 1 question each.
No, sir, let him ask 2 questions. That's fine.
Thank you. We'll move on to the next question. The next question is from the line of Avinash Singh from Ashreq Capital. Please go ahead.
Hello, sir. Just thank you for the opportunity and hope you all are doing fine. So just wanted to ask, wanted to get a sense that since now we are planning to launch our own app, previously we were using the aggregator. So these facilities, ordering facilities will be available both on aggregators and the own app. Or in addition, if we are getting most of the orders from the own app, so what will be the uptick in the margin that we can see? That's all from my side.
Yeah. Let me take that, Prashant. First of all, we will continue to build our business with the aggregators. So we're not stopping doing that. I think it's a good platform. It's if you look at the aggregator app, it's like a food court, right, with all the options on it. So we're not going to stop doing that. We're going to continue building up business with the aggregators. We are going to also build a business that never existed on our app, right? That this business never existed before. We're going to start building that on our app, and it's going to come with its own, kind of bells and whistles, and it's got, like a couple were saying earlier, a loyalty program that's not there in any burger business here in India. So we'll come up with the loyalty program. There's CRM, there's gaming, there's a lot of stuff we're putting in there to bring in a kind of customer that gets what we call as a super fan. Person who will want to be ordering and staying with the Burger King brand, who will be consuming the Burger King brand at an average rate of much higher than a normal consumer of Burger King. So that's why we call them super fans. So we'll build that business very separately. We have started identifying those trends, and then maybe Kapil can throw a little more finesse on this. So I'll turn it over to Kapil.
Yeah, I think just to add to what Raj said, I think delivery is a growing pie. I mean, it's a growing business, right? So we believe that there is space for branded apps there. Now, what the Burger King app will do, as Raj said, it's not about, being on aggregators or not being on aggregators. We'll continue to work with the platforms to grow sales. The platforms are doing a great job in growing the category, right? They're expanding the category of home delivery and the category of burgers on home delivery, right? And we'll participate in that strategy. While we build our own app for a more loyal base of consumers, it gives a more sort of native burger ordering experience. If you're not really looking for variety, you just want to order a burger, the simplest and the easiest way to come to order that burger will be on the Burger King app, right? And then it'll be sort of added on with the loyalty program, with other engagement programs to drive that platform. And we see both of them coexisting and growing the category.
Okay.
Thank you. So can we take one last question now?
Yes, please.
Thank you. The last question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Hey, hi, Prashant, Sumit. Thanks for the opportunity. I just quickly wrap up the question. It might take a little longer to answer. The fundamental question is that the Stunner is a fantastic idea, but having taken this clue specifically for India, I think it's a value for money market. And what I wanted to understand in terms of marketing, what's your understanding when you introduce new product or say maybe a value for money product, how much time in your experience is building up, saying moving from 50 rupees to say maybe 150 rupees burger or Whopper at 200 rupees.
So I'm looking more from the qualitative answer, saying that what is the consumer behavior suggests that how this upgrade happens, maybe very short span of time, or that is. And the related question is that when you're saying that your delivery is picking up faster, what is the ticket size change which is happening? So I tend to believe that when you're dining, I think your bill size is little bigger than the delivery. Is that the understanding is correct?
I'll let Raj take the first one and Kapil take the second one. Raj?
Sure.
Yeah. Thanks, Prashant. Look here, I'll let Kapil. I'll add on if Kapil, misses something, but I think let the CMO take both the questions.
Sure.
Go ahead, Kapil.
Sure. So on the Stunner menu and how the sort of menu laddering operates, right? There are different roles of these menu strategies. Stunner is a recruitment strategy, right? We want to sort of allow many consumers to come and access the brand Burger King. And as you rightly pointed out, the products available on the Stunner menu are the same great quality that we offer on the Whopper, the same great taste and great, highest quality of ingredients, right? So customers get recruited through this platform, and then they graduate with the brand over a period of time. Now, there is no formula, across the marketing world which tells you that at what point in time and in how many months and days will that happen. But yeah, we've seen that journey happen over a period of time. What we made sure is that the customers get the same great quality experience and taste excitement even at the entry price point, right? And that's why the effort behind building a great variety of menu, innovative formats, and offering the consumer all the stuff that we are in the Stunner menu. And as we roll it out in the coming quarters, you will share more on how that's scaling up, right? That's on the Stunner menu. Now on the check, yes. So I think you've got to mention that our dining check is higher than delivery. No, our delivery check is higher. Delivery typically is higher check for every business, because there's a larger group sizes at home, especially in this situation where people are working from home. You have the whole families at home, and we are sort of tapping into that opportunity by offering a lot of combos and innovative bundles, which allow the consumers to get value even at home, for larger group sizes, for families, right? So it is higher than the dine-in check, and you've seen that pattern over the last 1 year.
Thank you, Kapil. Just quick follow-up. This Stunner is gone into all 265 outlets?
Yes, Stunner is available in all the outlets. It's been soft launched right now. We're just putting it up. We will be activating the marketing program in the following quarters.
All right. Thank you, and all the best to you, team.
Thank you.
Thank you.
Thank you. I would now like to hand the conference over to the management for closing comments.
Yeah. So, go ahead, Prashant.
No, sir, go ahead, please.
Okay, thank you. Guys, again, really appreciate your time. I know that it's been a long day and you've had other calls prior to this. So I really appreciate not only your time, but your energy around our brand. It's been a blessing to have each one of you. I've read so many of your articles and all the stuff that you write in different, magazines and newspapers. I'm, really blessed that there's so much energy around the brand. And I thank you for that. My team over here is committed to, being as transparent as we can. We obviously need to protect our business for competitive reasons, but there's no other reason that we would withhold any information. I think we are giving as much as we can, and we'll continue to do that. So thank you again for your time today. And if there's anything else, Prashant, I'll turn it over to you in terms of even housekeeping.
No, thank you, sir. Thanks to each and every one of you who joined the call and made time to attend this. Please stay safe, and we'll see you in the next conference call. Thank you, guys.
Thank you.
Thank you. On behalf of Edelweiss Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.